Introduction. Overview of distressed real estate markets. Welcome to our course module on the overview of distressed real estate markets. Distressed real estate refers to properties that are under a foreclosure order or being advertised for sale by the lender. These properties often come into play when the property owner is unable to continue making mortgage payments, leading the lender to seize the property to recover the loan. Understanding distressed real estate markets is a crucial aspect of becoming a successful real estate investor. These markets offer unique opportunities that can yield high profits if navigated correctly. But keep in mind, along with the potential rewards come risks and challenges like dealing with property damage, legal issues, or an unpredictable real estate market. These markets often emerge from broader economic downturns, housing market crashes, or even localized issues like the collapse of a major local employer. Therefore, keeping a pulse on economic indicators both nationally and regionally can be critical to spotting distressed markets. In many cases, these distressed neighborhoods can be recognized by multiple foreclosures, neglected properties, and a drop in housing prices. Purchasing distressed properties requires strategic negotiation, proper valuation, and often a quick turnaround time. Distressed properties tend to be priced lower than their actual market value, making them attractive investment options. In the upcoming modules, we'll explore different ways to profit from these distressed markets, including long-term rentals, house flipping, and seller financing. Stay tuned as we deep dive into each of these methods, providing you with the tools to turn challenges into opportunities and maximize your returns in the distressed real estate market. Let's embark on this exciting journey together. Explanation of potential profitability. The heart of real estate investing lies in the adage, buy low, sell high, and distressed real estate often presents the perfect opportunity to buy at a significantly lower price point. Properties in foreclosure, or those otherwise classified as distressed, are typically undervalued due to the urgency of the sale. The seller or lender is often seeking to recoup their losses quickly, and this can create a window of opportunity for savvy investors to step in. The potential profitability from distressed real estate can be substantial. For example, investing in a distressed property and rehabilitating it for rental can generate steady cash flow over time, often at rates higher than traditional rental properties due to the lower initial investment. Flipping the property or reselling after improvements can also yield a significant return on investment, particularly in a rising market. Distressed real estate can also offer a path to profits through wholesaling, where investors purchase contracts on distressed properties and sell those contracts to other buyers at a markup. Similarly, seller financing allows investors to act as the bank, creating potential income through interest on top of the property price. However, it's important to note that these ventures aren't without risks. They require thorough due diligence, a solid understanding of the property's true value, and careful budgeting for potential renovation and holding costs. Throughout this course, we will discuss strategies to help you navigate these challenges, maximize your profits, and minimize your risks in the distressed real estate market. Let's start unlocking the potential of these unique investment opportunities. Identifying distressed markets. Understanding economic indicators. Economic indicators are vital tools for predicting shifts in the economy that could lead to distressed real estate markets. They offer investors crucial insights into the health of the overall economy and, by extension, the real estate market. A fundamental indicator to keep an eye on is gross domestic product, or GDP. A declining GDP can suggest an economic slowdown, which could impact the housing market and lead to increased foreclosures. Unemployment rates are another critical economic indicator. Higher unemployment can mean more people are unable to meet their mortgage obligations, often resulting in increased foreclosures and more distressed properties in the market. Interest rates set by the Federal Reserve also play a significant role. When rates are low, more people are incentivized to borrow, pushing up demand for real estate. Conversely, when rates rise, borrowing becomes more expensive, potentially leading to a slowdown in the housing market. Housing starts and building permits provide insight into the future supply of homes. A decrease may imply that demand is outpacing supply, potentially driving prices higher. On the other hand, a surge in these numbers could indicate an oversupply, which might lead to a market correction. Lastly, keep an eye on the delinquency rates on loans and the number of foreclosures. An uptick in these numbers might signal a distressed market on the horizon. Understanding these economic indicators, among others, equips investors with the information needed to make informed decisions. As we delve deeper into distressed real estate markets, we'll continue to reference these indicators to navigate the ebb and flow of the market successfully. Let's continue on this enlightening journey. Recognizing distressed neighborhoods. Often, distressed properties are not isolated incidents, but part of a broader neighborhood or community facing challenges. Therefore, recognizing the signs of a distressed neighborhood can provide investors with a head start on locating potential investment opportunities. One sign of a distressed neighborhood is the presence of multiple foreclosures. An unusually high number of properties on sale or in foreclosure proceedings may indicate financial instability within the neighborhood. Neglected or poorly maintained properties are another telltale sign. This could suggest that homeowners are under financial strain and unable to maintain their homes properly. Unmaintained homes could lead to a drop in overall neighborhood appeal, and consequently, property values. Also, keep an eye on local business activity. The closure of local businesses, particularly those that serve as community anchors like grocery stores or schools, may signal economic distress. A decline in local housing prices, especially when contrasted with nearby or similar neighborhoods, can also indicate a distressed neighborhood. However, it's important to differentiate between a market correction and a genuinely distressed market. While these indicators can help identify distressed neighborhoods, it's essential to consider the broader context. For instance, a neighborhood could be distressed due to temporary factors, such as a natural disaster, which could mean a quicker recovery. Identifying distressed neighborhoods is a key skill that can help real estate investors spot opportunities. By recognizing the signs and understanding the context, you can position yourself ahead in the world of distressed real estate investment. Let's navigate this intriguing landscape together. Buying distressed properties. Steps to locate distressed properties. Welcome to our course module on the crucial steps to locate distressed properties, an invaluable skill for any real estate investor looking to succeed in this market segment. Step 1. Research local markets. Begin by analyzing markets showing signs of distress. Look for neighborhoods with a high number of foreclosures or where economic indicators point to potential distress. Step 2. Network with professionals. Build relationships with local real estate agents, attorneys, and lenders who can provide valuable insights and may know of properties not yet listed publicly. Step 3. Utilize online resources. Online property databases, foreclosure listing services, and local county websites often list distressed properties. Auction sites can also be a valuable resource. Step 4. Drive or walk through neighborhoods. Physically exploring neighborhoods allows you to observe first-hand signs of distressed properties, such as neglected homes or for sale by owner signs. Step 5. Check public records. Foreclosure notices, default notices, and tax lien records are often accessible through local government offices or online databases. These can lead you to distressed properties before they are widely advertised. Step 6. Direct outreach. Consider reaching out directly to homeowners in distressed neighborhoods. Some may be willing to sell before entering foreclosure. While finding distressed properties requires time and effort, these steps can streamline the process and increase your chances of locating these potential investment opportunities. Throughout this course, we will discuss how to apply these steps effectively and what to do once you have found a distressed property. Tactics for negotiation and purchase. The first step in the negotiation process is understanding the value of the property. You must consider the current market value, potential repair costs, and projected after-repair value. Armed with this information, you can make an informed offer. It's crucial to remember that distressed property sellers, whether homeowners facing foreclosure or banks offloading assets, are often motivated to sell quickly. This urgency can work in your favor during negotiations, potentially leading to a purchase price below market value. Next, understand that patience is key. Distressed properties often involve complex legal proceedings, especially in foreclosure cases, and these can take time. Patience can pay off with a lower purchase price. As for the purchase, consider using cash if you can. Cash offers tend to be more attractive to sellers and can expedite the transaction. However, if a cash purchase isn't feasible, securing pre-approval for a mortgage or a hard money loan can put you in a strong negotiating position. Always be ready to walk away if the deal isn't right. Even though a property might seem like a great deal, if it doesn't meet your investment goals or the costs to rehabilitate it are too high, it's okay to pass. Finally, consider working with a real estate attorney who specializes in distressed properties. They can help you navigate the legal complexities that sometimes come with these types of investments. As we move forward, we'll delve deeper into each of these tactics, ensuring that you have a firm grasp on how to successfully negotiate and purchase distressed properties. Let's continue on this exciting path of real estate investing. Profit margins and maintenance considerations. Profit margins are the lifeblood of any business. They represent the difference between revenue and expenses, and understanding how to optimize them is essential for achieving sustainable profitability. By effectively managing costs, increasing revenue streams, and maximizing operational efficiency, businesses can enhance their profit margins. One key factor in maintaining healthy profit margins is efficient cost management. This involves identifying cost-saving opportunities, negotiating favorable contracts with suppliers, and implementing effective budgeting strategies. By analyzing and optimizing expenses such as raw materials, labor, and overhead, businesses can reduce their overall cost structure and increase their profit margins. Furthermore, diversifying revenue streams can bolster profit margins. Relying solely on one product or service can expose a business to market volatility. By expanding product lines, targeting new markets, or introducing additional services, businesses can tap into new sources of revenue and reduce dependence on a single product or market segment. This diversification not only strengthens profit margins, but also enhances the resilience of the business. However, profitability is not just about increasing revenue. It also requires careful attention to maintenance considerations. Neglecting maintenance can lead to costly repairs, reduced productivity, and even safety risks. Regular inspections, preventive maintenance, and timely repairs are essential to ensure the smooth functioning of equipment, facilities, and infrastructure. In addition to physical maintenance, it's crucial to invest in the maintenance of customer relationships. Satisfied customers are more likely to become repeat customers and refer others to your business, ultimately contributing to increased revenue and profitability. Building a strong customer service culture, implementing effective customer retention strategies, and continuously improving the customer experience are key to maintaining a loyal customer base. Moreover, investing in employee training and development is a form of maintenance that can yield significant returns. Well-trained and engaged employees are more productive, provide better service to customers, and contribute to overall operational efficiency. By fostering a culture of continuous learning and providing opportunities for skill development, businesses can optimize their human resources and drive profitability. Profit margins and maintenance considerations are two essential pillars of a successful business. By managing costs, diversifying revenue streams, and optimizing operations, businesses can enhance their profit margins. Simultaneously, prioritizing maintenance, both physical and relational, ensures the long-term sustainability of the business. Remember, profitability is not just about the numbers, it's about creating value for customers, employees, and stakeholders alike. So let us strive for excellence in managing profit margins and prioritizing maintenance to build thriving and sustainable businesses. By doing so, we can not only achieve profitability, but also create a lasting impact in our industries. House flipping process of house flipping. House flipping is an art that requires a combination of strategic planning, market knowledge, and a keen eye for potential. By understanding the process and following proven strategies, you can navigate the house flipping landscape with confidence and maximize your profitability. The first step in the house flipping process is thorough market research. Understanding the local real estate trends, identifying target neighborhoods, and assessing the demand for renovated properties is essential. This knowledge will guide your decision-making and help you identify properties with high profit potential. Once you have identified your target market, it's time to find the right property. This can be done through various channels such as auctions, foreclosure listings, or off-market deals. It's crucial to conduct due diligence and evaluate the property's condition, potential repair costs, and estimated after-repair value, ARV. This information will help you make informed purchase decisions and ensure you acquire properties that align with your profit goals. After acquiring the property, the renovation phase begins. This involves creating a detailed renovation plan, selecting materials and finishes, and managing contractors and subcontractors. Effective project management is crucial to stay on schedule and within budget. It's important to strike a balance between cost-effective renovations and creating a desirable and marketable space that will attract potential buyers. As the renovation nears completion, it's time to focus on the marketing and selling phase. Professional photography, staging the property, and effective listing strategies will help you showcase the property's best features and generate interest from potential buyers. Pricing the property competitively and strategically negotiating offers will maximize your profitability. It's essential to understand the local market dynamics and work closely with real estate agents or brokers to ensure a successful sale. Throughout the entire house flipping process, careful financial management is paramount. From budgeting for acquisition and renovation costs to securing financing and keeping track of expenses, financial acumen is crucial to ensure a successful venture. It's important to work closely with lenders, accountants, and financial advisors to optimize your financial strategies and maximize your returns. The process of house flipping is a dynamic and multifaceted journey. By conducting thorough market research, acquiring the right properties, renovating with vision, executing effective marketing and sales strategies, and managing finances diligently, you can turn distressed properties into profitable investments. So, get ready to embark on this exciting journey, armed with knowledge and strategies to become a successful house flipper. Financial analysis and profitability. Financial analysis is the process of evaluating a company's financial statements to gain insights into its performance, strengths, and weaknesses. It provides a comprehensive view of the company's financial position, allowing us to make informed decisions and drive profitability. One of the key aspects of financial analysis is understanding the company's profitability. Profitability ratios, such as gross profit margin, operating profit margin, and net profit margin, help us assess the company's ability to generate profits from its operations. By analyzing these ratios over time and comparing them with industry benchmarks, we can identify areas of improvement and take appropriate actions. Furthermore, it's important to analyze the company's revenue streams and cost structures. By conducting a detailed revenue analysis, we can identify the most profitable products, services, or customer segments. This information enables us to allocate resources effectively and focus on high growth and high profit areas. Cost analysis is equally important in maximizing profitability. By scrutinizing costs, identifying inefficiencies, and implementing cost-saving measures, we can improve the bottom line. Techniques such as activity-based costing, cost-volume profit analysis, and variance analysis can provide valuable insights into cost structures and help in making strategic decisions. Cash flow analysis is another crucial aspect of financial analysis. It helps us understand the company's ability to generate cash, manage its liquidity, and meet its financial obligations. By analyzing cash flow from operations, investing activities, and financing activities, we can assess the company's financial stability and make informed decisions regarding investments, loans, and dividend distributions. In addition to financial analysis, effective financial planning and budgeting are essential for maximizing profitability. By setting financial goals, creating budgets, and monitoring performance against targets, we can ensure effective resource allocation and control expenses. Regular variance analysis against budgets can help us identify deviations and take corrective actions promptly. Lastly, it's important to consider risk management and return on investment in our pursuit of profitability. By assessing the company's risk profile, implementing appropriate risk management strategies, and evaluating potential investments based on their return on investment, we can make informed decisions that balance profitability with risk tolerance. In conclusion, financial analysis is a powerful tool for assessing a company's profitability and driving its financial success. By analyzing profitability ratios, revenue streams, cost structures, cash flow, and implementing effective financial planning and risk management strategies, we can maximize profitability and create long-term value. So, let's dive into the world of financial analysis and unlock the potential to achieve sustainable profitability in our businesses. Seller financing, also known as owner financing, is a method of purchasing a property where the seller acts as the lender and provides financing to the buyer. Instead of relying on a traditional mortgage from a bank or financial institution, the buyer makes payments directly to the seller over an agreed-upon period. One of the primary advantages of seller financing is its flexibility. It allows buyers who may not qualify for traditional loans or have limited access to funds to purchase a property. Sellers, on the other hand, can attract a larger pool of potential buyers and negotiate favorable terms, including interest rates and repayment schedules. Seller financing can be structured in various ways, including land contracts, lease options, or installment sales. Each method offers unique advantages and considerations. For instance, a land contract allows the buyer to make payments directly to the seller while occupying the property, with the title transferring upon completion of the payments. Lease options give the buyer the right to lease the property for a specific period, with an option to purchase it at a later date. Installment sales involve the seller financing a portion of the purchase price, with the remaining balance paid in installments over time. Seller financing also provides additional benefits such as reduced closing costs, faster and smoother transactions, and potential tax advantages for sellers. Buyers may benefit from lower down payment requirements, more flexible terms, and the ability to purchase a property that might not be available through traditional financing. However, it's important to note that seller financing also comes with potential risks and considerations. Sellers need to assess the buyer's creditworthiness and may require a larger down payment or higher interest rate to mitigate the risk. Buyers must carefully review the terms and understand their financial obligations to ensure they can meet the payments. Seller financing offers a flexible alternative to traditional financing options in the real estate market. By understanding the various structures, benefits, and considerations, both buyers and sellers can explore this avenue to facilitate property transactions. So, let's embrace the possibilities of seller financing and unlock new opportunities in the real estate market. Strategies for negotiating seller finance deals. Negotiating seller finance deals requires a thoughtful and strategic approach. It's crucial to understand the motivations and goals of both the buyer and the seller to find common ground and reach a mutually beneficial agreement. First and foremost, thorough preparation is essential. Before entering into negotiations, gather as much information as possible about the property, the market, and the seller's situation. Understanding the seller's needs, financial position, and any constraints they may have will enable you to tailor your negotiation strategy effectively. Establishing rapport and building trust with the seller is another critical aspect of successful negotiation. Demonstrating your seriousness as a buyer, showcasing your financial stability, and emphasizing your commitment to fulfilling the terms of the agreement can foster a positive relationship and increase the seller's confidence in your ability to execute the deal. During negotiations, be prepared to present a compelling case. Highlight the benefits of seller financing, such as a potentially higher selling price, a steady cash flow for the seller, and the ability to attract a larger pool of potential buyers. Emphasize your financial strength, including your creditworthiness and the availability of a reasonable down payment. Consider offering incentives to the seller to secure more favorable terms. This could include a larger down payment, a higher interest rate, or a shorter repayment period. By sweetening the deal, you can demonstrate your commitment and willingness to work with the seller's needs while still achieving your own objectives. Active listening is a key component of effective negotiation. Take the time to understand the seller's concerns, priorities, and any specific terms they may be seeking. By actively listening and responding to their needs, you can find creative solutions that address their interests while also meeting your own goals. Finally, be willing to walk away if the terms do not align with your objectives. Negotiation is a give-and-take process, and it's important to know your limits. Having alternative options and being prepared to explore other opportunities will empower you to negotiate from a position of strength. Negotiating seller finance deals requires careful preparation, effective communication, and a willingness to find common ground. By understanding the seller's perspective, presenting a compelling case, offering incentives, actively listening, and knowing your limits, you can navigate these negotiations successfully and create win-win outcomes. So, let's apply these strategies and unlock the potential of seller finance deals in the real estate market. Conclusion: encouragement to seize opportunities with knowledge and preparation. Knowledge is the key that unlocks doors of opportunity. It is through learning and acquiring new skills that we expand our horizons and open ourselves up to a multitude of possibilities. By investing time and effort into gaining knowledge, we equip ourselves with the tools necessary to navigate the unpredictable twists and turns of life. Seizing opportunities is not without its challenges. It demands courage and stepping out of our comfort zones. It requires us to take risks, to embrace uncertainty, and to be resilient in the face of setbacks. But with knowledge and preparation as our armor, we can overcome these challenges and emerge stronger than ever. Remember, the world is full of untapped potential waiting to be discovered. By seizing opportunities with knowledge and preparation, you can shape your own destiny and create a future filled with endless possibilities. The power lies within you, so go forth, seize those opportunities, and let your potential soar.